Thank you for joining me. I'm Mitch Goldberg with Client First Strategy. This is a show about the stock market, investor education, personal finance education. We're here to help you make better decisions with your money. Today, we're going to talk about the tariffs. Investors are not waiting for Trump to decide about tariffs. He's talking a lot about tariffs, but investors just decided we're going to buy right now, setting the major averages up a lot today. What else? We're going to talk a little bit about municipal bonds, a couple of key things you should know, and we're going to get into just a little bit of crypto as an example that the bullish fever that continues to take on Wall Street is in full force, but is it overdone? Is there just too much speculation in the market for investors to feel safe? We're going to talk about these things and what you should be thinking and maybe what you could do to protect yourself. So here we go. Hey, everybody, I'm Mitch Goldberg with Client First Strategy Wealth Management Firm. And what we're going to talk about first is tariffs. So today, Trump said he's thinking about a 25% broad-based tariff on our two biggest trading partners. It's not China, it's not Japan, it's Mexico and Canada. And we do a lot with them. We send a lot of stuff to them. They send a lot of stuff to us. And it's been an incredibly good symbiotic relationship. But the thing about the tariffs is valuations by all things that I could possibly think of are pretty high. I'm talking about the stock market. I'm talking about what I think is a fever pitch of speculation in crypto, things like Fartcoin and weird stuff like that, becoming worth billions of dollars overnight without any effort or valuation metrics behind them. The Trump coin, the Melania coin, you have to admit, this is pretty speculative stuff. And I understand we call this animal spirits. That's the term, animal spirits, when investors are just bullish no matter what. All bad news is blown off. All good news is interpreted as great news. It's the opposite of a bear market where no matter how good the news is, everything is interpreted as bad news. And we are in that particular moment of animal spirits, which is sky high. Major averages went up a lot today. But the reason they went up, you could come up with all the reasons you want. The given reason that the markets went up is Trump didn't come out and do anything in tariffs. He signed a lot of proclamations, a lot of the presidential powers to stop things, start things, changing the energy sector, immigration. But he didn't do anything on tariffs today. So the thinking is that maybe some people in his sphere of influence are saying to him, and maybe it's sinking in, that we need to slow down and think about where the tariffs could be and how they could be targeted. Tariffs could be done right? They could be done right. And maybe that's what he's thinking, because he said a lot of things on day one, and we haven't seen any tariffs, which he's talked about, the on day one stuff. So what is the deal with the tariffs? Tariffs could be good for a couple of reasons. It could encourage more manufacturing domestically. So if U.S. companies see that they could actually compete fairly and that their products could compete with those that come from China or Mexico or wherever else they could come from, maybe they'll be incentivized to make products here. Because why would you make a product here if no matter what you do, it's going to be cheaper and just as good if it comes from China? There's no incentive whatsoever to do that. So he's creating a he wants to create a global new order, a new global order, however you want to put that, to to increase manufacturing in the United States. Trump started that. Biden continued that and did even more. And Trump is now going to see how far he could take it. But the key is with tariffs, if you just make imports from China, for example, more expensive, and if we don't have an alternative supply of these products elsewhere, well, then these products just become more expensive and it's inflationary and interest rates go up. That is antithetical to everything that Trump is trying to do in his agenda. So we need to do a slower move first. And what I'm saying with that is that we need to build up the manufacturing here for things that we use, from sneakers to electronic components. If we could make them here first or gradually turn up the tariff heat on foreign nations and give our companies here time to get ready to meet consumer demand, then I think the tariffs could have their intended benefit. If not, it's just going to mean higher prices. So maybe that's something that's holding Trump back from putting on immediate tariffs right away. Keep in mind, we do a lot of trade. It's not all imports. We do a lot of exporting to foreign nations too. And if there are places where the business is not fair, then we should go after it. I'm all for that. And that's why I think you haven't seen blanket tariffs enacted today. That is the reason given on all the major outlets, Wall Street Journal, CNBC, that the market went up today because the tariffs didn't come by. Now, the market is pretty high, and I'm not saying it's overvalued, but it's highly valued. I think we could agree on that. Now, the old expression goes from John, I think John Maynard Keynes is quoted with this, that a irrational market could stay irrational longer than you could stay solvent. So I'm not bashing the market or saying you should sell. You know, asset management is a big part of what we do. But you should know that if stocks are going up due to a perceived view in Trump's mind that we're not going to do blanket tariffs, and then he does blanket tariffs, I think the market could be setting itself up for disappointment, aka a fall. We shall see. So what I'm saying is, don't buy stocks based on tariffs or not today. I've said many times before the election, we are not making decisions based on the election. We are not buying or selling in clients' accounts because of the election. We're going to keep doing our job, which is help our clients build investment portfolios based on their risk tolerance, their time horizon, and their financial goals. And we're hoping to achieve a stock market return that is above and beyond that of the inflation rate. That's what the stock market investing is for. If you're just looking to get rich quick and you think that if I'm telling you that if the stock market can grow it on average, it's grown at 9.6% for the last, 50 years, a lot of people might say, who wants that? That kind of stinks. It's not good enough when I'm making, 100%, 200% all over the place. We will get to that point where 10% annualized growth is a pretty good deal. We will get to that point where 4.5% on a bond, that is, that's a pretty good deal. But it depends on what you're comparing that to. The only times in my career, which is 35, 36 years now, where I've seen investments rise far, far above and beyond the long-term return of the stock market was 2000, 2007, 2008, or 2006, 2007, really, and now. So we'll see what happens. Einhorn, David Einhorn. Let me put this up on the screen if I could get this here. David Einhorn, noted hedge fund investor who's extraordinarily successful, says we've reached the fart-quench stage of the market cycle. What does he mean by that? When billions of dollars are created out of thin air overnight on nothing, just because investors are having FOMO, fear of missing out, and they're jumping in the next thing and they seek up a little bit. So it makes more investors jump into it. And then everybody feels smart because they bought something that went up. That's what's happening. Now you might say, gee, Mitch, those sound like the words of somebody who missed out. No, we're doing pretty well. And my clients who are watching this know we're doing pretty darn well. I also let my clients know that this is an unusual period to be doing this well. I'm not taking the credit. There are certain stocks that I recommended a long time ago that I truly did not expect to do this well. We're long-term holders. We're benefiting mightily. But, if you're telling me somebody predicted that NVIDIA would go from a $300 billion market cap to a $3 trillion market cap at the time it did, I don't know anyone who predicted that. Do you? But when you're a long-term holder, you could wait and see. So we are looking to me at a super speculative cycle in anything that could be traded today. It's tulip mania. It's a gold rush. When does it end? I don't know. But it takes a lot to create billions of dollars in value. It takes a lot of brain power, a lot of people. It just takes really so much science or economics or engineering, software design. So now, I hear what you're saying. Trump wants to create a committee to come up with regulations to finally make crypto more readily available. He wants to do something so he could let banks trade it, and banks have said they would be happy to trade crypto. Banks are happy to trade. Banks are happy to trade in any market that's a multi-billion-dollar market because they make money trading. They make money buying and selling as brokering and agency and principal, all these things that market makers do. It might be good for them. It might not, but it doesn't mean it's good for you. So, we keep saying this buyer beware with crypto, and crypto keeps going up. And the people who say buyer beware sound dumber and dumber. And there's a lot of people who don't know anything about investing who are feeling very smart and thinking very highly of themselves because they're jumping on the bandwagon, they're chasing performance, and they're thinking that they must know something. And they go, "Oh wow, I'm really smart. I really do know how to invest." You're just all piling into the same stuff at the same time, creating billions and billions of dollars in weird coins overnight based on nothing except that you're all doing it at the same time. Good luck when you all want to get out at the same time. So buyer beware. And maybe Bitcoin's the real one and everyone else is the fake one. We'll see. Maybe Bitcoin is not the real one that's going to survive. And and the coin that works long term will be something else. We don't know yet. We'll see. Enjoy the ride. So let's talk about Netflix real quick. Okay. Netflix is popping. It's up 13% after market, up $115 a share. Now you might say $115, that's huge. Listen, if a $10 stock went to $11.30 in aftermarket, you go, oh, that's a nice move, up a little bit over $1. Still 13%. So if Netflix goes up $150, keep in mind, it's still 13%. But this is one of the things that adds to the bullish case for stocks that says, well, if they're overvalued, that's one thing. But if their numbers keep proving that these companies are not overvalued, that there's still growth left in the tank, then maybe we should keep buying them. That, to me, appears to be the case with Netflix. We shall see. We're pretty diversified here. By the way, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily prevent your portfolio from going down in a generally down market. Now, we're diversified. Very important. So we just feel that, I certainly feel that when you have stocks that go up a hell of a lot, you can hang on to them, but it's not a bad idea to take a little gain off the table. For example, Jim Cramer, Mad Money, always says, don't trade Apple, own Apple. But he did sell some Apple around 260 at its all-time high to reduce his position. You know why he did that? Because just in case, you never know. So I think if you have to rebalance your portfolio, that's a good reason to take a little gain off of stock. You could still hold on to a lot of the stock or a little bit, whatever's right for you, but don't be too greedy. Maybe invest in something else. Take some of that money off the table and put it into a bond. Like, let's say, a municipal bond. I want to talk to you real quick about municipal bonds. Now, municipal bonds are this really big corner of the bond market. Municipal bonds are issued by municipalities, counties, cities, states, and generally speaking, the interest that they pay is tax free for the residents of that particular state. So if a New York City bond is out and you could buy it and you live in the state of New York, it's tax free. You don't have to pay state income tax, which is something that's pretty high in the state of New York. You don't have to pay federal income tax, and you don't even have to pay New York City income tax. Triple tax free right there. And it's about a $4 trillion market. Not nearly as big. It's a little bit more than 10% of the total treasury market, but nonetheless, it's a pretty big corner of the market. It's considered very stable. It's also known for low defaults. It's a pretty rare thing to see a municipal bond default. It's a pretty rare thing to see people lose money on a municipal bond, providing that they held it to maturity. So, a couple of things you should know about municipal bonds. One of the things is there's two main types. There are revenue bonds and government obligation bonds, also called GO bonds, GOs, government obligation. Um, Revenue bonds are basically backed by tolls of a major bridge or the ability or a transit system of a city, for example, or on a stadium. Whereas government obligation bonds, those are based on the taxing authority of the municipality that issued the bond. So it could be based on the county tax, the sales tax. It could be based on the income tax of a city like Los Angeles or Illinois. City, you name a city. Miami, well, it wouldn't be Miami, but you could name any city you want. New York City, okay. New York City has a pretty big market for municipal bonds, so that's why I pick on them a lot. But any city in a state that has a state income tax. So, but anyway, the point is government obligation bonds are backed by the taxing authority of the municipality, of the issuer. So if they need to raise more money to pay the interest and principal for that bond, they could just tax more. So for municipal bondholders, that's important. Now, for the residents, no, that's not a good thing, right? And you could say if the cities would just lower their taxes, one of the reasons why cities and counties and states can't just lower their taxes is because they have obligations to the bondholders. They made a commitment, signed a contract. We have to pay X amount of dollars, and we can't lower the tax base if it's going to take away. We can't lower tax rates if it's going to take away from our ability to make good on these bonds. Plus, they don't want to take away from the, daily services that they provide for their residents. Also, that's why it's very hard to cut taxes. It's very easy to raise a tax, but once you raise the tax, the money is spent. So it's almost impossible to cut a tax unless somehow you're going to borrow from somewhere else. So that's what you should know about municipal bonds. There's a lot more to know about municipal bonds, and we will get into that as time goes on. But just so you know, municipal bonds are tax-free, and there are taxable municipal bonds also. There are some municipal bonds, roughly 10% of the municipal bond market, are subject to federal income taxes. So instead of buying a 10-year treasury, let's say right now around 4.5%, you could buy a 6 or 7 year municipal bond that pays 4.8 or 4.9%. And you can even buy these in a tax sheltered account like an IRA or a Roth IRA, because it doesn't matter if they're municipal bonds, they're taxable. Some people say you wouldn't buy a municipal bond in an IRA. They're wrong. A taxable bond, a taxable municipal bond, you certainly could buy in an IRA, and it's often a better rate, a higher yield than the equivalent term of a treasury bond. These are the things that you should know, and these are the things we get into with our clients. So that's about it for the show. Thank you so much for watching. If you want to know more about what we're talking about, feel free to reach out to me, give me a thumbs up or a like or whatever, in whatever platform you're watching this on. It helps me, it helps the algorithm, and I get to see who's out there watching, and I always appreciate that. Reach out directly if you're a little shy, if you have a question, if you don't want to post in the comments, but I do love to hear from you in the comments. And if you're watching this in the replay, thank you so much to you as well. All right, see you tomorrow.